Is it better to buy a house when prices are high and interest rates are low, or to wait for interest rates to go up and for housing prices to come down? So, which is the better move? It depends on how you're paying. So, if you're paying cash, obviously it makes more sense to wait until prices come down, which they will. Rates are on the rise, they're going to continue to go up. At some point, we have to reverse what's been going on with all of the stimulus and all of the monetary policy at bay right now in 2021 due to the pandemic. So the real question is, what's the best bet if you are financing? Should you wait for housing prices to come down when rates go up? Or should you buy now when housing prices are at all-time highs, but rates are at all-time lows? So the thing to consider and look at is, number one, your payment. So if you're buying a payment, which is what most people are doing, you can only afford so much of a payment based on your debt to income, all those types of things, and your money that you have coming in. So you want to look at what is the payment that you can afford, and how does that affect things at the end of the day from a 30-year mortgage standpoint. So it's an interest calculation. So you need to do the calculation and look at what are the effects of interest rates as they go up 1% on the overall cost of that loan over the long haul. So generally, it's going to work out that if interest rates are up 1 or 2%, it's actually better to buy a more expensive house at a lower interest rate over a 30-year period than it is to wait for a 10 or 20% discount on a house with a 1 or 2% higher interest rate. Because again, for every 1% rates increase, that increases or that decreases the price of a house by by about 10%. So for every 1% rates go up, the price of a house will decrease by 10% based on the payment of a 30-year mortgage if the payment stays the same. That's kind of how it works, roughly plus or minus. So you want to keep that in mind. So as rates go up, you're going to pay more interest over the 30-year period. So it actually might make more sense to pay a little bit more for a house when interest rates are at all-time lows. And even though houses may come down in price, you're going to pay exponentially more in interest over a 30-year period as those rates go up. So you want to make sure that you look at that calculation and think about it. And if you're thinking about buying a house, or if you're on the fence, it may make more sense for you to pay more for a house if you can get that interest rate locked in, especially under 3%. That's just unheard of. They're not going to get lower. You're not going to see rates get much lower than what they've been, which has been about 2.75, 2.8 for some people that jumped in at the right time. 3% is kind of a number, and it's already gone up this year, and it's going to continue to go up as we have to issue more debt. Investors are going to be looking for more yield. So keep an eye on interest rates, understand how that affects the overall cost of the loan over 30 years, and understand what your goals are. Are you in for the long term? Are you in for the short term? Are you buying a fixer-upper where you can build equity and create value to exit that property? And generally, for the most part, most people are thinking, it makes sense to buy if you're going to be in a house for 5 years or longer. If you're going to be in for less than 5 years, unless you get a deal and buy under market value, it may not make sense. So those are the types of things to consider in terms of housing costs, and how the interest rate is affected by a 1% move, or how the interest that you pay on the loan is affected by a 1% move over a long period of time, like 30 years. So keep that in mind when you're looking at that, and I hope that helps you in terms of trying to figure out, should you buy a house now with low interest rates but all-time highs on housing values, or should you buy or wait to buy when housing prices come down and interest rates go up? Because prices will come down. Good times never last, bad times never last, peaks and valleys over the course of history of all asset classes. We see ups and downs. We see prices go up, they come down, they go up, they come down. So that's the nature of things. Housing has been on a steady incline over the history of housing in this country. So it has gone up every year, just like stocks have gone up every year. We are in an exponential spike right now, an unusual inflationary period due to the monetary easing, low interest rates, free money. So that is amplifying the price and values of assets out there. So that will come down. It will come home to roost at some point once we get through the pandemic, get it all behind us. They're going to have to unwind all of this artificial inflation that's been thrown out there at the asset level, which is real estate, stocks, bonds, cryptocurrencies, all that kind of stuff. It's all about monetary policy right now, and that will unwind at some point. Nobody knows how long it's going to take, but it will. So just keep an eye on interest rates, keep an eye on monetary policy, and look at the overall cost of that loan, not just the price you're paying.